Let's talk to a couple of economists who'll know a lot more than me. Joining me, partner at Deloitte Access Economics, Stephen Smith, and Barrenjoey Chief Economist, Jo Masters. Jo, I might start with you. You would have been reading this today. I guess we'll find out some of the reasoning tomorrow, or a bit more of it. What have you made of these predictions on inflation?
So we haven't got the full suite of numbers yet. I think that's the most important point to make up front. And in particular, the forecasts that have been released through the media are all about CPI, or headline inflation. And of course, we need to remember that the Reserve Bank targets trimmed mean inflation, or underlying inflation. So it'll be important to see the detail in the numbers once we get the budget. Having said that, I think the numbers that have been released don't look too dissimilar to our own forecasts here at Barrenjoey. And one of the big differences between the Treasury numbers that we're talking about, or the budget numbers, and the RBA is that the RBA's numbers were finalised prior to the announcement of the electricity rebate from Queensland, also the Victorian and WA budgets, and of course there's clearly some targeted cost of living relief that technically lowers measured CPI in the budget. So the RBA numbers don't yet have all of that, and we'll need to be reconciling that on budget night once we've got complete details.
Yeah, and I guess the RBA can give us its update soon enough. Stephen, what do you make of that sort of reasoning, I suppose? Because, well, even that side gets complicated, right? Because, as Jo pointed out, it brings down CPI directly, but there tends to be money to spend. How much of that is spent becomes the big question.
Absolutely, and that's really the big test in this budget. Exactly what it does to inflation. There's what Treasury is expecting in the budget papers, and Jo's exactly right. They've got all the detail at the moment, and we don't have the detail until tomorrow night. And so, a little bit of a wait and see as to exactly the spending measures, exactly the cost of living relief, and how that's targeted. Agree with Jo as well that our numbers are a little bit higher on inflation than what it looks like Treasury will include in the budget tomorrow night. But it's all about really how consumers respond, and particularly what's coming down the pipeline is those stage 3 tax cuts. And the second half of this calendar year is really make or break for inflation. We still think it's possible the RBA will be cutting at the end of this year in November, but it's a bit of a wait and see.
Look, I know we've become very obsessed in the media, and I'm part of that, around when a rate cut comes. But much more importantly for households, is it the start of a few, and what that means the new level is. So part of the prediction here, Jo, is actually that inflation settles, if you like, a bit higher at 2.75%. Now, the RBA is meant to be aiming for 2.5 specifically now, but it does have some wriggle room. And then there's the headline versus the trimmed mean you spoke about. So did this concern you at all, that inflation's settling a bit higher, and what that means for whether there will be those, multiple rate cuts that get us close to sort of 3% as a neutral money setting, if you like, from the RBA?
Yeah, I think this is a really important debate. So I guess there's two questions when we get the budget tomorrow night. The first one is really a focus around FY25 and maybe the first half of FY26 in terms of cost of living and inflation, and can we get to rate cuts? Now, here at Barrenjoey, we've got our first rate cut penciled in for February. The second part of the equation is, I guess what you've highlighted here, is how many can we expect and how far can we expect that rate cut cycle to go? And there, I think the budget is more inflationary than we see probably in FY25. That's not unique to Australia. We're seeing a range of things that have changed post-pandemic that are inflationary. We've got higher expectations of what governments deliver into economies, so more government spending. We've got the energy transition, reshaping of global supply chains, geopolitics, increased climate events, and demographics. So all of these things are making inflation longer term likely a bit higher than what we've experienced in the decade before the pandemic. I think the debate is still out about how much higher. So we do have a series of rate cuts in our forecast. It's a bit slower than we would have seen in previous cutting cycles, though. So we've got 4 25 basis point rate cuts through 2025, but we've got the cash rate settling at in the high 2s. So that's much higher than we experienced for that pre-pandemic period.
Yeah, higher than that, but then lower if you go back to the period before then. So, what is the real normal? And part of that, Stephen, as well, is this sort of strangely sacrosanct understanding that inflation should be between 2 and 3%. That's been the understanding since central banks were sort of twiddling the dials, right, since about 30 years ago. Nothing's set in stone, is it? So, I mean, could it be that there's an acceptable higher inflation that doesn't damage economies? Is it a possibility that the RBA becomes comfortable with something a bit higher and still has rate cuts to get the economy going, even though traditionally you'd say, hey, inflation's on the high side?
I mean, as you said earlier, the RBA's mandate is now to target specifically 2.5%. And the reason for that, the reason why the communication around 2 to 3% or now 2.5% is so important is those inflation expectations. We hear people refer to those expectations all the time. That's about, how fast do employers and consumers expect prices to be growing? And if consumers do expect prices to be rising faster than 2.5%, call it 2.75 or 3% on average, that they're then going to argue for higher wage increases.
Yeah.
And that's what the RBA is really trying to avoid.
It's the behavioural economic side, isn't it? Now, there would still be the live question of, is that still the magic number between 2 and 3? But we've just had a review, Joe, that says, hey, let's get even more specific, 2.5. It's not an old review. It still is yet to be seen whether it stands the test of time, though. But the RBA, it can't just go off on a frolic and decide that's no longer fit for purpose, can it? I mean, it's really bound by this.
Well, it's absolutely bound by this through the RBA legislation and then through the charter, the policy agreement between the governor and the treasurer. I think this idea that central banks globally and in Australia will accept higher inflation will take many years to play out. It takes a long time for these policy frameworks to change. And as you said, I think at the moment, we do need to see the RBA targeting towards 2.5. And again, that comes back to the fact that pre-pandemic, we had a long period where inflation was too low. And the argument that economists made at the time that the RBA should have been cutting in 2018.
Yeah, well, that's part of the reasoning, isn't it? That give them a broad band and they'll still miss it by a bit. Look, I've got people excited, maybe just myself, at the thought of an interest rate, or the RBA with 3, so a lot of rate cuts to come. Bring us back down to earth, Stephen. What's the big risk of sticky inflation where we just can't get a grip on it and we see maybe one rate cut and that's it for a year or two?
Look, that's certainly possible. And a big reason why that's possible is, if you look underneath the headline inflation numbers at the components that are really driving or continuing to drive inflation, a lot of what started this inflation cycle has now gone away again. The import prices, supply chain congestion, et cetera, that we saw through the pandemic. We're now into the more services sector, the stickier side, components of the basket, and so that's things like residential rents, insurance, and things that energy, those sorts of things that the RBA doesn't really have direct control over, and so are much more difficult, just for a blunt interest rate sort of policy lever to control. So yes, there is a risk, particularly on housing. We're very concerned, as I think most economists are around the country, that we just won't get that supply response quickly enough. And so, rents look like remaining, the growth in rents looks like it's remaining.
And it's a big part of the spend, but then does the RBA say this is a volatile measure? Look, that's up to them to decide. They know more than me. They're paid more, so they can figure that out. Steve and Joe, thank you. We'll let you get away and study up for your budget 24-25.